it's going to double that. And so there's a lot of interest, and that's where that, the space has grown, and there's all the marketing claims. And so it's gotten really confusing. And so this is a framework that we've built to help investors understand the space. And it usually is the start of every conversation we have around sustainable investing, just to get some definitions down so you understand it. Okay. So I think that there's probably 1,000 ways to invest for sustainability, but I think you can categorize them into 3 buckets. Okay. Yep. ESG, SRI, and impact. Now, like I said, people use those terms differently. I'm going to define the way we use them, and it'll help you categorize things. Now, you'll see 5 buckets there. And the reason why I have 5 buckets is I want to bookend those 3 categories with things that I know you already are really familiar with. One, conventional investing on the left, which is maximizing financial return for a given level of risk. That's how conventional investing has always been done. And then on the other side is philanthropy, right? Where you're not really concerned with financial return. I mean, you're giving the money away, right? You're concerned with solving a social or environmental goal. So these bookends, right? On the left, it's financial first. That's your primary goal. Yeah. And then on the other side, philanthropy, impact first is your goal. Are good, valuable bookends, right? Because they're at the extremes. Now, a lot of people, and I used to be this way too, invest that, handle their finances that way. You invest for total return or maximizing your total return and in one pocket, and then you give to charity in the other pocket, okay? But over time, more and more people are getting less enamored with that approach, and they want a more blended approach to their finances. And so sustainable investing has come along, or responsible investing, as an option for them. And the original one, okay, that's been around for hundreds of years, is socially responsible investing. And the original, what SRI originally meant was this: an investor, typically a very ethical or religious investor, who is seeking to maximize total return, just like a conventional investor, but they had some no-go areas. They had a problem with alcohol or tobacco or abortions or weapons or something. Their religion, their morals, their compass, their values said, I can't invest in that. In the US, the Quakers actually codified an investment principle that said our members, Quakers, should not invest in companies that profit from slave labor. This is over 100 years ago. Okay. So this is, it's been around, and you can see what's happening there. They're balancing their economic goals, right? Their pursuit of economic value with their individual values. Okay. So that's why we put it in the middle. It's a balancing. Nowadays, SRI is a bit more sophisticated. You can invest for your values, not just excluding companies, but they're balancing that trade-off all the time. All right. Now, the next, go ahead.
That's an interesting framework, and folks can maybe figure out at a high level where are they or where do they want to be, and then pick one of these areas and maybe dig a little bit deeper in this quest of simplifying and understanding this complex picture. Yeah.
And if you're feels very strongly about certain things, SRI, individual things, like if you just, maybe you're a cancer survivor or something, or it's in your family, just like, there's no way I can put money into tobacco, probably make sure you get a portfolio that doesn't invest in tobacco companies, right? That's what that category is for. And it's a great way to invest your money if those things are important to you.
Okay. And by the way, Sam, just to clarify, all these are irrespective of real estate or the type of.
They're across all asset classes. Across all asset classes.
Yep.
The next category is impact. And you see I've put it over there next to philanthropy. And there's a reason why that. The original form of impact was not an investment strategy so much as it was an alternative to philanthropy. What do I mean by that? A bunch of very wealthy philanthropists, capitalists who were giving money away to certain charities to solve some problem, were realizing that they kept writing those checks. Okay. And the problem was being ameliorated for a while, but it wasn't going away. It wasn't being cured. Okay. And the classic example is Bob Geldof with We Are the World and all that, right? Sending a whole bunch of money down to Africa and coming back a couple of years later, and they're still poor and they're still hungry and they're still need medicine to be shipped in from the north. Okay, so some of these wealthy capitalists came up with the idea of, let's put some for-profit models in there to solve those social and environmental problems. Okay.
Okay.
My favorite parable is, if you give a man a fish, he eats for a day. If you teach a man to fish, he eats for a lifetime. If you give that man some capital, he can start a fishing business, maybe buy a boat, hire some people, and he can feed the whole village for a lifetime. Okay. That's the idea around impact investing. Okay. Now, if you get some return, if you get your money back, or you get a healthy return on your capital, that's great. You probably put it back into the project. But you can see it's kind of like a private equity or a project-based or private debt situation, where you're really just focused on that individual problem and providing catalytic capital to that.
Okay, so we covered SRI, we covered impact, and now we're moving on to ESG, which is an acronym, right? What's in it?
So ESG stands for environmental, social, and governance investing. Okay, and unfortunately, they've taken that term, like I said, and used it for all of this stuff. But ESG originally was not a values-based strategy. It's in the blue bucket. It came from large pension funds who were looking at things blow up in their portfolio and going, is there any way we could have anticipated that? Right. So you might remember the Bhopal chemical spill in India, right? Huge problem. Like, is there anything that these big institutional asset managers could have foreseen about that before it happened? BP with Deepwater Horizon, Volkswagen with the Dieselgate scandal. Earlier than that, Exxon Valdez, Exxon with the Valdez oil spill. What these asset managers and pension fund managers were doing is saying, is there anything we can see outside the balance sheet, outside of the income statement, outside of the typical reporting package that companies provide, that will give us insight into these environmental risks or social risks or governance risks? For example, does this company make products that relies on free and abundant natural resources? Are those free and abundant natural resources going to be there forever? Or might there be some constraints? Do they pollute a lot for every product do they make? Do they rely on cheap labor in Southeast Asia that might have some human rights issues? Is the board looking at the management team and has good risk oversight? Those are environmental, social, and governance issues, and they're all tied to economic value. Now, it turns out that companies that are good at treating the environment well, are good at treating people in their supply chain well, are attractive to the sustainably minded investor. They're taking care of people and planet in their pursuit of profit. So ESG has become a very popular way for in fact, the most popular way for the sustainable minded investor to invest. And the great thing about it is
almost hijacking the whole umbrella of terminology, right?
Oh yeah, and that's why they use it for everything, because over 90% of the money invested sustainably now is in ESG. Okay, not in these other categories, because you don't have to give up financial return. So you can invest for sustainability and get the similar returns that you get from conventional, provided you do it right. There's a lot of caveats there, right? And so that's the spectrum that we lay out: ESG, SRI, and impact. And you can obviously use a blend of them in your finances, what works for you. Us personally, we love ESG for our retirement and education portfolios, and we have a bunch of money in impact because we like solving individual things that we care about.
Okay, so you have your balance sheet of values, if you will, as an investor, and you allocate some to maybe long-term personal needs in terms of your retirement plans, and then you allocate something towards your social impact and how that capital can improve on a particular issue that's important to you.
Yeah, and the impact stuff is money we can afford to lose because we might lose it, right? And the ESG stuff is stuff that we need for our future.
Okay. Well, that's helpful, and thank you. I see already a question. We'll tackle it in a little bit. Edward, thank you for submitting it. Just want to highlight to everybody, if you have questions about what you've heard so far, or maybe anticipating throughout the session, please put them into the chat box. I do see them, and we'll try to get to them. But so Sam, this was very helpful as far as understanding what to look for. Can we talk a little bit about how to look for? So what type of data or resources are available to investors if they want to evaluate how their assets are deployed along this spectrum from left to right?
You know, I'm glad you asked that, because sometimes I feel like uh, with the internet, everybody knows everything all the time, or at least it's obvious. You just Google it and you find it, right? But this is new. Um, ESG is coming on, and sustainable investing is coming on so quickly that there's all these new tools that are out there that nobody knows about. So I really love this slide. And we can send it to people who want it afterwards. You can now, for free, go online to Morningstar, and they'll give you a sustainability rating on any equity mutual fund and ETF. Okay, so Sustainalytics provides the ESG data on that. MSCI just 2 months ago made all of their fund ratings free, and they publish it on the internet, right? And this is both for fixed income and equity investments. US SIF is a membership organization for asset managers who are committed to sustainable investing. And so that's a good short list. If the asset manager is a member there, you can get information on them, and just having them be members tells you a lot there.
There's some sort of commitment they have to do in order to join that group?
It's not actually that big of a commitment, but you know, it's like being a member of it says that this is you're very serious about sustainable investing. The principles of responsible investing, UNPRI, almost every asset manager is a member of that, right? This is a tighter group of those who are willing to advocate and do engagement and try and improve things in financial services and capitalism at large.
Okay.
And then the last one, if you go to fossil-free funds or tobacco-free funds, all kinds of URLs, you can go to As You Sow or the investyourvalues.org website. Any mutual fund you pull up, any equity mutual fund, it'll list every holding that you might find objectionable to: coal, tobacco, gambling. There's gender equality now. There's all kinds of ways. And you just look up a mutual fund that you're invested in, that you're considering, and see if they hold anything that you have issues with.
And Sam, when we talk about, let's say, an expense ratio or a return number, that's pretty unambiguous as to what it means.
Yeah.
Is there something similar when we talk about sustainability and these ratings, or is there a degree of, you know, variability when it comes to these four or maybe other resources that people might use?
That's a great question. And it's really a thorny issue because it's not a strictly quantifiable number. Now, these guys on the page here, Morningstar and MSCI and the other ESG researchers, are trying to do that, right? They're trying to give you a score, a letter grade, A, B, C, D, or a number, you know, or 3 out of 5 or something like that to tell you how sustainable that is. But I want to caution people that I like to refer to those as opinions. Okay, much like a stock analyst might give a buy, hold, or sell rating on a stock. Like, they've looked at all this data and then they've come up with a decision that says this is a buy, this is a hold, this is a sell. Well, that's their opinion, right, of what you should do with it. These are these entities' opinions on these companies or these funds. And you just got to understand that they're trying to apply a numeric or a grading system to a very qualitative process. And so it's not like an expense ratio, Olivia. It's not a hard number. So a little bit more digging is worth your while.
So if somebody were to pick one of these entities because they recognize the name, would you say it's a good place to start, but look a little bit into their methodology, which I think is public, right? They disclose how they come up with these ratings, and make sure that methodology kind of resonates or captures what you're interested in.
Let me give you an example. Morningstar uses Sustainalytics and MSCI uses their own system. Actually, Morningstar now owns Sustainalytics, but they both rate Tesla, right? And MSCI, I can't remember which one is high, which one is low, but one of them loves Tesla because it's a sustainable product, right? And it's advancing renewable energy and electrification and all that. So they give it a good rating. The other one gives it a poor rating because Elon Musk, as chairman, the governance structure of Tesla are pretty poor relative to other companies. And so they get a low rating. Well, what's important to you, right? So that's what I mean by it's more of an opinion than a hard number.
Got it. Okay. Okay. So we talked about the spectrum. We talked about some tools and resources, and both these topics cover investments at large. Can we talk a little bit closer to your expertise in terms of the asset class of real estate, and maybe some nuances in terms of how a real estate investment might be evaluated for sustainability relative to other type of investments? Obviously, we have buildings, we have warehouse assets, we have maybe land, perhaps. So help us understand a little bit the nuances when it comes to real estate sustainability.
Okay, happy to. So one thing we got to keep in mind here, a level set of the background. In the early days of ESG, these research providers tried to give you a score. They'd have to measure everything in the kitchen sink, and they'd have like 187 variables, and they'd give everyone a score, and they'd weight those, and they'd say, okay, this company's an A, this company's a B. 5 years ago, a little longer, they started shifting that to saying, listen, we need to focus on what's most material for these companies, right? So in a bank, health and safety is not really as much of an issue as it is in a mining company or a construction company, right? And so it's about, okay, let's pay attention to things that matter. We went through a big process with the research and a bunch of academics and an evidence-based process to find out what matters in real estate. And here are our qualifying criteria and our disqualifying criteria. And some of these things overlap with like normal or conventional equities like energy and emissions reductions, hugely important, right, in all companies. Also very important in real estate. Real estate uses 40% of the world's energy, creates 33% of the world's greenhouse gases. Your buildings, the buildings in the US and around the world, push out 33% of the greenhouse gases in the world. Now, no one talks about that. They talk about energy production, they talk about transportation, but buildings are the users, right? So if we want to fix the emissions problem, the climate problem, we got to work on the buildings. Okay, now thankfully there's a lot of solutions to get buildings to net zero and to reduce the energy use and reduce emissions. So there's a lot of solutions. So there's a great opportunity here in real estate to get more sustainability. So you'll see things that overlap with general companies and real estate like that. But then there's some things that are very specific to real estate, like green building certifications or green leasing, affordable housing, those types of things.
And are those things focused both on when the building is put together, when at the building construction stage, as well as once it's operated? Like we can't just build everything anew today, but we have a lot of inventory, so to speak. So I'll throw some jargon at you. There's embodied carbon. That's the carbon footprint of you building the building, what it takes to put into the building, and then it's embodied in it. And that whole process, which is what developers and manufacturers have to be concerned with about. And then there's operating carbon, which is now that the building is built, how is it using energy through time, and what is its carbon footprint? We're investing in public REITs, real estate investment trusts, which own and manage properties, and they're not really developers or builders. So this is around the operating carbon. But if you were looking at a home builder or a developer, you'd want to focus on the embodied carbon. Both of them are important. It's just a question, again, of what's material to the companies that you're looking at. I see. So are the builders offering or publishing sustainability stats related to some of their products? Could somebody look at, hey, I want to buy from this builder versus another one based on the embodied carbon, or is it too early for that type of distinction?
No, they are. It's really exciting, okay? And we got to remember, on a public company or even a private company, the pressure to be more sustainable comes from a couple of places. There's the companies that want to be that themselves, right? Yvon Chouinard with Patagonia, right? Just came out like that. Some companies are responding to investor pressure right? That's saying, hey, you got to be better at this. You're a big public company. You got to be more sustainable. Okay. And some of them are responding to their clients' demand. And good examples are home builders in California, okay, are saying, okay, and then there's also the regulator, right? The home builders in California are saying, okay, we're going to build, 100 homes in this new development. What do we want them to look like? Well, Californians want solar. They want energy efficiency. They want, landscaping that doesn't take a whole ton of water. Well, some of them do, right? Well, now they want really powerful sprinklers, but for another reason. Sorry. And so the ones that are looking out longer term and seeing, okay, there's a regulatory thing coming on the horizon. There's investor concerns on the horizon. Our own clients are asking for things. They're enveloping this thing. And one of the thesis of ESG investing is that the companies that are paying attention to this stuff now are better prepared for the future. Let me give you an example. We hold a bunch of REITs that own properties in Manhattan, in New York City, and they passed a very aggressive climate law that says if you do not reduce your carbon emissions from your building over the next 10, 20 years by 20, 30%, we will fine you by the square foot. And those fines can reach into the tens of millions of dollars. So some of the REITs who've already made their buildings efficient are like, we're good. And the other REITs are like, we have a bunch of crappy old buildings. We got to fix them up to get them ready, right? So that's kind of where real estate is going. And it's exciting because there are lots of ways to make real estate more sustainable, more efficient, and it's more profitable because they're using less energy through time.
Okay. So I see here on the Vert ESG criteria, a disqualifying criteria. So one particular type of asset that I think usually is captured in real estate type of investment trust, prisons. So is Vert, for instance, excluding all prisons of any kind, or is there such a thing as a green prison?
In the U.S., there's no green prisons. In the U.S., there's two private or public companies that are prison REITs. And again, we only invest in REITs. We don't invest in other types of property owners. And those guys are not sustainable, right? When the business model is we only make more money when we lock more people up for longer periods of time and give them less services, it's hard to make that business case sustainable. Now, other countries have different systems. So you could argue that there are some sustainable prisons out there, but those guys aren't real estate investment trusts. So we do a blanket exclusion.
Got it. Okay. So we have a question here. One term that maybe more folks are familiar with, because usually you walk into a LEED certified building and they let you know about it at the door. So the question is a LEED rating for commercial buildings a guideline for ESG investing in real estate?
Yeah, so we use that as one of the criterias. You see green building certifications. That includes LEED, which is the US kind of centered one, BREEAM, which is UK, but all of these guys are going international, CASB and Neighbors, and there's a whole range of certifications around the world, and we use them. And the way it works for us is if you're top decile, if you have more of your buildings, more square footage of your properties qualified in some green building certification, which remember takes time and money to do, then you're more committed to sustainability. So for us, the way we capture the leaders in sustainability is we have a cutoff. If you're top decile on this metric, you can qualify into the portfolio. Now, a lot of people have LEED certified buildings. It's becoming more and more common. It definitely is a marker of sustainability. And so if you're doing a lot of it, we think you should be rewarded with inclusion in the portfolio.
And then for you, there are other things in addition to the green building certification, as we listed here, the social and governance criteria, right?
Yeah, and some of these things overlap. Green building certification is a perfect example. We have it in environmental here because it's reducing energy and emissions and reducing waste and water use. But a lot of those LEED building points that you get for certification are around health and well-being, which is a really social aspect. Is how healthy are the tenants in that building, whether they're residential, like in their apartment units, or if they're office workers. Is the air quality good? Are the surfaces clean and non-toxic? Those types of things, which used to be like a kind of a nice to have, but recently, what is it? Oh yeah, COVID. It's kind of making that a must have, right? So again, an example of companies that were ahead of the game and had their buildings green certified, have better indoor air quality, have healthier buildings. They might get a bit more attention from, people who are returning to work than the ones that aren't going forward.
Got it. Okay. Randy, thanks for the question. And we have a question also from Edward. This is getting a little bit more into performance and trade-offs, but the question is, and I guess everybody can see it, how does ESG, so the question at least says ESG specifically, not sustainable in general, but how does ESG impact the yield return trade-off with risk?
So I think there's a question there of short-term versus long-term there. And this is one of the fascinating things about ESG. A lot of projects make sense the longer term you look at them. I'll give you an example, right? Changing the light bulbs to LED doesn't cost a lot, pays for itself in like a year or two, right? Buying that Google Nest smart thermostat for your house, a couple $100, save that amount of energy in a year or two, right? So it's a positive NPV project. You're making money off of this really quickly, easy to explain to the board, to the management team, everybody's on board. Some of the stuff takes a lot longer. It's 5 years, it's 7 years, it's 10 years. Now, we want to invest in the companies that are looking really long-term because it's still a positive NPV project. You just need a longer-term perspective. And one of my it's bigger than a pet peeve. It's a real problem with Wall Street is this obsession with quarterly earnings and 3-month numbers, and it's ridiculous. So one of the things that we're looking for is companies that are saying, listen, this might be more costly in the short run, but in the long run, we're going to make more money. And that's pretty much not just a good investment strategy for anyone. Just take a longer term perspective, okay? But just think about how that accrues over time, and the company gets even stronger and stronger and more profitable if they can take that longer term view. And if they've given the ability to do that from the investor community,
Okay. So I'm cautious of time, and I do want to save some time for the specific actions we can do beyond investing. Before we move there, and Sam, feel free if you think this is too long of a topic, but we have a question here about politics at the federal level and whether they impact your outlook on sustainability and the analytical process that you use to review sustainability for Vert. And again, feel free to say, look, it's too broad of a topic.
How many hours you guys got? How many years you guys got? No, listen, here's the thing that we're trying to do. The grander mission is if we can get capitalism to get companies, if we can get markets to get companies to be more sustainable because investors demand it, we don't have to rely on policy as much. Now, we need both. We absolutely 100% need good, strong policy and regulations. And I'm not talking oppressive and anything like that, but we need good policy to move us to a low carbon economy. But if capitalism is encouraging it, it's way faster and it's way more reliable than politics, right? Okay, so if all of a sudden there was a carbon price, like we're still waiting around for the politicians to do that. But if companies were saying this is a real price that's coming down the pike, so we're going to factor it into our calculations, capitalism would be doing this by itself. So yes, policy is important, but I'm a capitalist. I would prefer it if capitalism would do this. And I'll give you an example around financial advice. In Australia, 10 years ago, they banned commissions. So a financial advisor couldn't make revenue selling you some crap product. They had to charge you an advice fee, right? And that was regulated. In the United States, we got there without the regulation, okay? people just were like, I don't want to pay commission anymore. I'm going to get an advisor that's working for me, not working selling products. So you can get there in both ways. Capitalism is faster and it's stronger and it's less variable to the winds of politics.
Got it. Okay. Well, thank you. That was a concise answer. Thank you.
Wasn't it? I felt like I went on there a little bit.
No, I like the comprehensive view of how you can make change and the interplay between politics and
so here's a personal one, because it's an election year. All right, the citizen of the 20th century thought of their civic duty as a contributor to society. They thought their mechanism was the democratic process. I will vote, I will contribute, I might campaign, I might write some letters, I might do something local in my government, what have you. That's great. That's all part of our civic duty. But that was the end of it. That was what they thought you could do. Now, the citizen of the 21st century realizes that, whoa, money has power. And in some cases, money has a lot more power than the democracy, right? And so I want to be intentional with my money, where I spend it, what I shop, what I buy, where I save it. I used to bank at Wells Fargo, no longer. Okay. I mean, the scandal is just too much. I moved my money. All right. And where you invest. All right. Investor choices matter. And people are waking up to that. And they say, you know what? I don't want to give my money to these companies that are doing bad things. I want to give my money to companies that are doing good things. And so there's this understanding now that the way you can affect the world is a lot more comprehensive than just the democratic vote.
Got it. Okay. Well, thanks, Sam, and Gina. Thank you for the question as well. So let's move on. We had 4 objectives we told folks we would cover today, and the 4th one is actions you could take beyond investing to promote sustainability. Maybe your portfolio is already where it needs to be, or maybe you feel your portfolio you're just building it, so the impact might not be as great there. Tell us a little bit about other things beyond investing, Sam.
I love this stuff. I mean, I love sustainability, and I love finding ways that sustainability is fun and not too intrusive or limiting to my life, right? And if you're wondering why Elon Musk has so many fanboys, like I'll raise my hand here, is that there's a lot of people who like driving, but they don't like polluting the planet. Okay, and here along comes a solution that's like, okay, you can have driving back because it's not polluting the planet. And by the way, the driving is super fun. You're like, thank you, right? So there's all kinds of wonderful solutions out there. And
hey, Sam, sorry, do you need the slide still?
Yeah, let me share with you the slide. So for Earth Day this year, we invited a bunch of people to do a webinar, a Zoom meeting like this, and we just said, not about investments or anything like that. Just tell us what action you take in your life that makes you happy, right? That you get rewarded from, that you just like doing, that you'd like to share with other people. So that was our Earth Day theme. And I took the names out, but a bunch of people, called in and I share some of them with you here. And they just said, this is how I like to contribute. This is what makes me feel good. Now, it turns out that we do know the top 100 solutions to climate change. This book called Drawdown by Paul Hawken. If you don't have it, you have to get it. It literally is the book on how to be more sustainable. Now, it's not directed towards individual actions, but what we did is we matched up what people said they like to do with those actions to give you an idea of how important that is. So here's a couple of examples. Reduce meat consumptions. I make the tacos in the family every Tuesday. So Taco Tuesdays, I figured out how to make beans taste good. And now I don't have to put any meat in the tacos anymore, okay? Simple. My kids don't think tacos have meat in them. Fantastic, right? Not that hard. My own little impact in the world, yeah, but it's the number 4 solution in the list of top 100. Plant-rich diet. And that's amazing. So there's a lot that people can do, and a lot I'm sure that you guys could share that you guys do that could help us, the rest of us as well.
So can you give us a couple more teasers, things that might surprise us from the
Oh,
book?
today, check CNN. Okay, couldn't believe this because I was telling Olivian about this just the other day. He was like, giving an example. I said, imperfect produce. You ever heard of it? He's like, no. What is it? Okay, you know those CSA boxes where you sign up and they send you some fruit and vegetables in a box every week or every month or how often you want it. Well, there's this one company called Imperfect Produce that takes the fruit and vegetables that's totally fine and it's organic. It's just a little misshapen, like the oranges are too big or they're a little lumpy or something. And instead of throwing them out, they put them in the box, and now you get this very interesting organic box of fruit, and you get twice as much as you get in a normal CSA because this stuff is basically going away for free. Now you're reducing food waste. You're getting more food for free. I mean, more food than that for the same amount of money. It's just a win-win. There's all kinds of stuff like that.
All right, so I see here the numbers on the right column represent the order of those items on the list in the book.
Yeah. So what Paul did with a bunch of scientists was say, okay, how do we rank order all the solutions to pull, carbon out of the air and put it back down in the ground and stop filling up the atmosphere? And then they said, if we did that solution at 3 different pathways, business as usual, medium, and aggressive, from 2020 to 2050, how much gigatons of carbon would we pull out of the atmosphere effectively? And then they ranked them on that basis. And then this is an even better story in here. Along with that is how much it will cost. Okay. And in almost every case, I think it's like 87 out of 100 cases, you save money by doing it. So for example, getting the world to switch to electric cars would save, a whole bunch of gigatons of CO2. And from 2020 to 2050, everyone saves money because we're not spending money on oil and gas anymore. A little bit more money up front, right? But then saving money.
Got it. Okay. Well, we do have a few more minutes before we can switch into networking. I want to see. We got one example here in the comments coming from India. Carrying a handkerchief in your pocket so you don't use paper towels in restrooms, and that's probably a location-specific type of item. I think a lot of restroom areas are moving towards the air vented type of hand dryers, but probably not prevalent.
But Olivia, that points out something about these sustainability things, right? Like one of the problems with this movement is that people are kind of preachy. They're like, stop eating red meat or stop doing this or stop flying or whatever. And some of those solutions don't work for other people, right? So a perfect example is in my house in Chamonix, France, near that mountain, has solar panels on it. My neighbor wanted to put them on. Doesn't work at his house. He doesn't have the solar gain necessary for it. So literally my next door neighbor can't do solar or doesn't pencil out. Mine does. So some things work and some things don't work. We banned paper towel use in my family. We had lots of cloth napkins that we're using and for cleans up and everything like that, and it was great. And I was all feeling all full about myself. Then we got a puppy. You need paper towels when you have a puppy, okay? I'm just saying. So some of these things work and some of them don't work depending on your situation.
Got it. Okay, and it's good to do as much as you can. Maybe don't get overwhelmed by the fact that you can't do everything, but there's billions of us on the planet, and we can all make a small difference, perhaps, right?
Yeah, well, this is what it's going to take more than, it's collective action, right? But we all can't coalesce around one solution because it doesn't work for some people. And so, people in India, people in China, people here, all pick the different solutions that work because we all got to get on the circular economy, low carbon path. And we can do it. The solutions are there. We know that now. I know there's a lot of doom and gloom. We just have the will to do it. And like I said, policy, personal action, and if capitalism helps too, that would be even better.
Got it. Okay. So Mark posted here in the chat about the New York Times article on climate maps transformed US. If folks wanna check it out, and original research related to the investment industry and how parts of the country could be impacted by these sustainability trends. Sam, one last question. I just thought about this. What's your view on population growth with regards to sustainability, if you have one?
So, Malthus, the guy who said the population bomb, we're all gonna die, and I just watched Infinity Wars. My son's 10th birthday, so sorry for the cultural reference, but Thanos wipes out half the population of the universe because he thinks that there's too many mouths to feed, right? Here's the thing. If we can get on a circular path, right? If my existence doesn't create any more carbon, okay? If I operate in nature like nature, okay? There are no waste products, it's all reused. We can fit a lot more people on this planet, okay? Our current system, which is take natural resources, make something out of them and throw them away, that's a problem. That's a linear process, and you can't do that on a finite planet. But a circular process where you're using the stuff that you discard can take a lot more people, right? So spaceship Earth, think of us as all on a spaceship. If we have a closed system and we're treating that closed system right, we can fit more people.
Got it. Awesome. Well, Sam, thank you, and thanks everybody for sticking with us and for all the questions. I did promise everybody that we were going to do a optional networking session. Everybody's welcome to stick around. Sam, if you maybe stop sharing for a second.
Yeah.
And I'm going to see. Thank you.
Well, I lost my mouse. Oh, there it is. Good, gotcha.
Okay, and I'm going to stop recording now.